Hey there, savvy moneymakers. Welcome back to Cents and Sensibility, the channel where every penny has a purpose. Today, we are going to talk about one of the most critical aspects of financial stability emergency funds. I am Srushti and I am here to share why these funds are crucial and provide you with practical tips on how to build and park them. Picture this that you wake up one morning to find out that your trusty car won't start. You call a tow truck and discover that it's going to cost you $1,200 to fix. Or perhaps you receive an unexpected medical bill that insurance doesn't fully cover. These are just a couple of examples of the uncertain emergencies that life can throw your way. But let's dive deeper into the critical nature of emergency funds with a few more eye opening scenarios. Imagine you are a homeowner and suddenly a massive storm causes significant damage to your roof. Without warning, rain starts pouring inside your house. The repair cost skyrocket to $5,000 and you are left scrambling to find out a solution to protect your home and your loved ones. In another scenario, you visit the doctor for a routine checkup and they discover an unexpected health issue that requires immediate attention. You are faced with specialized treatments and surgeries that are not fully covered by your insurance, leaving you with out of pocket expense totaling to $10,000 or more. These are just a few examples of the critical emergencies that can blindside you when you least expect them. They not only put a strain on your finance but also create emotional stress and disrupt our daily lives. That's where the power of emergency funds comes into play. Your emergency fund acts as a shield, protecting you from the unexpected financial burdens and allowing you to focus on what truly matters your well being and the well being of your loved ones. Remember, emergencies don't discriminate, they can happen to anyone at any time. Being prepared with an adequate emergency fund is a crucial aspect of personal financial management. It empowers you to face these challenges with confidence, knowing that you have a safety net to rely on. So, how much emergency fund should you have? Determining the appropriate amount for your emergency fund is a crucial step towards financial preparedness. While specific circumstances may vary, a general guideline is to aim for 3 to 6 months worth of living expenses. For example, let's say that your monthly expenses amount to $3,000, including rent, utilities, groceries, transportation, and other essential costs. In this case, a minimum emergency fund of $9,000, that is for 3 months, to $18,000, which is for 6 months, would provide a solid financial cushion to cover unexpected situations like job loss, medical emergencies, or major home repairs. However, it's important to strike a balance between having an adequate emergency fund and having additional funds available for investments or other financial objectives. Putting more than 6 months worth of money into your emergency fund may lock up your funds in a low interest account, missing out on the potential growth opportunities. By evaluating factors such as income stability, risk tolerance, and overall financial goals, you can find the sweet spot that works for you. A balance between financial stability and growth. Regular reassessment and adjustments are crucial to ensure your emergency fund aligns with any changes in your circumstances. Remember, personal finance is about finding the right balance that suits your unique situation and long term aspirations. Saving for an emergency fund is a crucial step towards financial security. If you're unsure where to start, I have got you covered. In a previous video, I discussed how to create a budget, which lays the foundation for effective financial planning. Be sure to check out the link in the description to watch that video if you haven't already. In that video, I talked about fixed and variable expenses. Fixed expenses are those regular recurring costs like rent or mortgage payments, while variable expenses can fluctuate, such as entertainment or dining out. Let's say, for example, you find that dining out is a significant variable expense in your budget. By cutting back on eating out and cooking more often at home, you can save a substantial amount of money each month. Those savings then can be redirected towards building your high priority emergency fund, ensuring that you have a safety net for unexpected situations. Remember, every penny counts when it comes to savings. For beginners, it's natural to feel overwhelmed when deciding where to allocate your savings. Should it be for that dream vacation, a new car, a down payment on a house, or an emergency fund? The key is to remember that building an emergency fund should be your top priority. While it may be tempting to focus on immediate desires or long term goals, having a safety net in place is crucial. Life is full of uncertainties and unexpected expenses can arise at any moment. By creating an emergency fund as your primary objective, you establish a financial safety net that will protect you during your challenging times. Once you have a solid emergency fund in place, you can redirect your savings towards other goals like that vacation or car. Prioritizing your financial security first will provide you with a peace of mind and the foundation to pursue your other aspirations with confidence. Remember, it's all about creating a stable financial foundation to support your dreams and navigate life's unpredictable moments. Now, where should you park your emergency funds? When it comes to saving your emergency fund, it's important to prioritize liquidity and accessibility. Emergency funds serve as a financial safety net for the unforeseen circumstances. So it's essential to keep the funds readily available when needed. This means that investigating your emergency fund in long-term investments or assets may not be the best approach. Instead, opt for liquid options that allow easy access to your funds without penalties or delays. While traditional saving accounts at banks like Bank of America or Wells Fargo may offer convenience, they often come with minimal interest rates. A better option is to consider high-yielding savings accounts like Barclays or Ally Bank, which are FDIC insured. These accounts typically offer higher interest rate, allowing your emergency fund to grow over time and combat the effects of inflation. With a high yield savings account, you can strike a balance between accessibility and earning potential. It's important to note that while the interest rate earned may not be substantial, the primary focus of your emergency fund should be its accessibility rather than maximizing returns. By choosing a high-yielding savings account or a similar option, you ensure that your emergency fund remains liquid and easily accessible while still allowing it to grow and maintain its value over time. Remember, the primary purpose of an emergency fund is to provide a quick and hassle-free access to the funds during the times of crisis. So, it's crucial to prioritize liquidity over potentially higher returns from long-term investments. So now get ready for the financial thrill ride that will have you saying, bring it on emergencies, because with the power of budgeting, saving and strategic planning, we will conquer the unexpected and transform into the true financial superheroes. Stay tuned for our next video on Sense and Sensibility, where every penny has a purpose.